All right, everybody, this is Dave Aquino with Basecamp Trading, and this is my 11-hour options strategy webinar. Thank you very much for joining me today. This is a really quick risk disclaimer. We here at Basecamp Trading want you guys to know that trading or investing always carries risks. I'm not going to read this risk disclaimer for you verbatim. I advise you to stop this recording, go ahead and take a look at this and read through it thoroughly so you understand that this information is provided for helping you make your own independent trading investment decisions. Please do not trade with money you cannot afford to lose, and any past performance is not necessarily indicative of future results. This is Rule CFTC 4.41. It's a U.S. government required disclaimer. Again, the CFTC wants you to know the same thing, that trading has both large potential rewards and risk. You must be willing to accept those risks and in order to invest in the stocks and options market. Again, do not trade with money you cannot afford to lose. Okay, a little bit of information about me. My name is Dave Aquino. I graduated from Vanderbilt University back in 1995. Shortly after I graduated, I became a general securities broker with Merrill Lynch, and I did that for a number of years, trading stocks, bonds, options, and doing a number of things as a broker, as a general securities broker, in the line of Merrill Lynch's products and services. A little bit after that, I joined the Vanguard Group outside of Philadelphia, Pennsylvania, in which I was elevated to the Vanguard Asset Management Service. I was a senior member of their Ultra Group for over 12 years. My role was to create cash flow strategies on highly appreciated stock that was owned by these very wealthy families, and so that they would generate a monthly cash flow in which the owners would never have to sell the stocks. Now, I've been with Value Charts and now Basecamp Trading for well over 5 years as the stocks and options live trading room specialist, and I'm happy to be with you. All right, so jumping right into our 11-hour option spread strategy. I came up with this strategy about three and a half years ago, and I've been actively trading it in my trading room with our members for that length of time. So I'm happy to bring you these 3 points to kind of explain a little bit more about 11-hour options. I'm going to first talk about the Greek of time. Options are governed by what we call the Greeks. The one that's most important to this strategy is the one that's governed by time. Next thing, we're going to talk about time decay and how that fits on a weekly calendar. And then I'm going to jump into the meat of the strategy, the 11-hour option spread strategy itself. Okay, so the essential Greek of time. This is the Black-Scholes option pricing model. This particular example is for call options. Thankfully, we don't have to do high-level math to understand options. We just need to know what parts are most important. And the one I want to talk about tonight is theta. Theta describes an option's sensitivity to time until expiration. It's actually a geometrically accelerating decline. So as we're further out from expiration, the decline is rather gradual. And as we get closer and closer to expiration, the acceleration or the decline of value of out of the money options starts to accelerate because we are getting closer and closer to expiration until we get to expiration day, and theta basically goes to zero when it's out of the money. All right. For monthly options, the greatest rate of loss due to time decay is in the last month, the last 30 days. For weekly options, the greatest rate of loss due to time decay is in the last 1 to 2 days. Now, option sellers use theta to their advantage. Basically, what they do is they collect this time decay in terms of profits. And if you're a credit spread seller, you're doing the same thing. You're selling options that are decaying and wasting away with the hope that they expire worthless. Therefore, you get to keep all the proceeds, we call that premium, from the sale of those options or option spreads. You can see right here that time decay It starts slowly right around 90 days, 60 days, 30 days. We kind of start hitting an inflection point here. 15 days, 10 days, 5 days, 1 day, 0. And again, the steeper the slope of this line, the more geometrically accelerating uh, the value of the option starts to dissipate. And that is called theta decay. So how do we use this theta decay? Or we also call it time decay. And how does it fit on a weekly trading calendar? So again, like I said earlier, for weekly options, the greatest loss of due to time decay is in the last 1 to 2 days. We use that behavior for our advantage because that's when we trade the 11-hour option strategy. Now, this is a normal trading week. Monday, we're directional trading, swing trading. Tuesday, directional swing trading. We can do this on the options that expire at the end of the week because we're not going to be in them that long. On Wednesday, we're doing a trade called the weekly power option credit spread. And on Thursday, this is the golden day. Around noon, we implement the 11-hour option strategy, selling 11-hour options quality credit spreads. And then we go through an overnight cycle, pop up on Friday, and we manage those spreads until the close. All right, so let's get into the meat of this webinar, the 11-hour option spread strategy. Okay, when I created the 11-hour option spread strategy 3 years ago, the goals were this. I wanted a high quality, high probability trade succeeding 80% of the time or more. I wanted a relatively short trading focus when we're talking about noon on Thursday into the 4 o'clock close on Friday. So that is the time period. That's actually the place that we derive the name, the 11-hour option spread strategy. Okay, the trade is actually based on a daily and 60-minute chart. Okay, and we evaluate the quality of the 11-hour option trade by evaluating momentum strength and direction. We're going to look at support and resistance levels based on the daily chart. And if we are trading basically a swing trading retracement, we're looking at Fibonacci retracement levels, or if it's a breakout, maybe Fibonacci extension levels. The net goal of these trades are basically overnight income or selling premium to generate overnight income. The one aspect of credit spread trading requires us to look at the charts, at the markets, from a different point of view. Most of the time, if a stock is steadily going up, we want to hop on that train that's going up. Instead, when we sell credit spreads, we want to instead focus on selling the short strikes that are currently away from the projected price direction. We want to be at prices where most likely will not be at expiration. All right, profits from the 11-hour option spread strategy come from theta decay, or the overnight decay of out-of-the-money options value. So something that we sell that is depreciating, and we hope that that thing that we sold on Thursday is worthless on Friday morning. Because if you think about it, the one sure thing in life is that Thursday will eventually turn into Friday. And because we are trading with time decay in our favor, then we're always profiting at least from one of the Greeks. The credit target rate that we're trying to generate in these trades is roughly 4 to 6%. That means for every $1,000 of buying power we commit to the trade, we're going to try to get anywhere from $40 to $60 of premium for each trade. Now, the thing about these trades, if you look at them on the surface, you'll say that the risk and reward is very outbalanced. It doesn't seem to be in our favor at all. Well, we manage this by limiting our risk through either trading techniques or stop loss levels to roughly 2 times the credit amount or 3 times the credit amount. If I'm trying to generate $100 in premium, I'm willing to risk anywhere from $200 to $300 loss. And we can withstand that because of the high probability of our trades. Here's an example of a setup for a bullish put credit spread. Okay, so basically what's going on, the stock price is falling down in Google. Okay, and this is on a daily chart. And it comes down and it makes this one bottom at roughly $856. Make a little intermediate high, and we come down and we make another bottom. And then momentum starts to go higher, price starts to go higher. And when we're doing this, where are we most likely not going to be at expiration? Down here. So that's why I'm going to sell my credit spread at roughly $840. I sell it down here and I'll make money. I'll get to keep my premium that I sold, and price should continue higher because not only is momentum carrying it up, but we've got support and resistance levels based on these two pivot lows, here and here. It's a very elegant way to look at the markets. It's not that we're concerned with jumping on the bandwagon that's moving higher. We just want to stay away. And when we can read the fact that momentum and price is going higher, and the fact that we have support levels here and here, we know that this is a very high probability trade. Because even if it could turn around and make a 180-degree turn, it would have to get through support at 856 and get through support at 845. Here's another setup. Maybe you've seen something like this in the markets. Okay, generally the markets move up and down, but sometimes we get these crazy channels that look just like this, right? So what happens if we obviously see price breaking lower through the channel, and we can see with our momentum indicator that momentum is quite bearish? You know what we can do? We can step in, sell a credit spread right here, and then not only, in order for us to lose on this trade, price would have to turn around, go through resistance here, go through resistance here, and in order to get to our credit spread, and guess what? We only have to be in the trade for 11 hours. So those people hoping that it'll turn around and go through two resistance levels are quickly running out of time. Remember, time favors the seller, and that's us. Okay, so let me just go through the 11-hour option spread strategy goals. Okay, when I created this, you know what? It reminds me, clicking through, want to talk about what are our reasonable aims. Okay, so this is a power of compounding chart. Now, I'm not promising you anything. I just want to show you some math. If we are looking at roughly a 3% weekly return, that is equal to 12.5% over the course of a month. And what does that look like? Well, if I take $10,000 and I'm compounding 3% per week, roughly multiplied out, that $10,000 becomes $46,500 in 52 weeks. It's an amazing number that these small weekly gains can add up to a much, much bigger number compared to where we started the process, started the year. Okay, keep that 3% a week in mind. So this is an 11-hour option strategy. You can see we're doing, in this case, Tesla, bearish call credit spread. All the details are right here, but we're making $440 after risking $5,000. So roughly this trade is about 8%. This trade is another $5,000 buying trade, and this one we are earning roughly 6%. And this trade, this is another $5,000 buying power trade. We're making roughly 5%. So all in all, when we total everything up in this example, based on $15,000 worth of buying power, we nearly make $1,000. And that is just one set of trades on 1 week in the 11-hour option spread strategy. Think about it. Think about it. That is a very consistent return that we can harvest from the market every single week. All right, so here again the goals that we were talking about. Consistent winners, consistent percentage gains, and controlling our losses. As of December 1st, 2016, we are looking at 209 trades that we've done overall for the year. 209 trades. Out of those 209 trades, we won 199 times. That is roughly equivalent to 95.4%. Can you imagine winning nearly 200 times in 1 year with these trades? That's consistency. The average weekly return. Now remember I showed you the 3% number earlier. The average weekly return on each of these trades is about 5.4%. 5.4%. I showed you the example of 3%. 5.4%. Okay, I wanted to give you a little bit of leeway. Maybe you have more losses than I do because I've been doing it a while. Maybe you're factoring in commissions. So think about it. Even if you could eke out 4% a year, that would be a tremendous amount per year. And what about those 10 losses? 10 of them were 6 were break even. That means going into Friday, we have a little bit of profit. We have a stop loss in there. If it starts to lose, we get out before it gets too big. So we try to get out as close to a $0 loss as possible. The other 4, maybe they're more involved, maybe the markets gap against us a little bit. We implement a strategy called the delta neutral. I teach that in a more advanced course, but in the case of the basic course, you would result in a 2 times or 3 times stop loss. But that's okay. If you think about it, 4 losses of reasonable size out of 209 trades, I'll take those odds any day of the week. Okay? All right. So again, we're talking about numbers, and again, I cannot promise you we're going to do this in the future, but like I've said, I've been doing these trades in my trading room for nearly 3 years, and I'm doing them in front of my trading room traders. Okay? So I have nothing to hide. Their orders are out there every week, and whatever the results are there for everyone to see. Again, the middle of the road number, 3% a week, 12.5% a month, 10,000 goes to 46,000. Now again, my number is closer to 5. Here is 4. You're looking 10,000 becomes this, 10,000 becomes this. Okay? The reason is, and most of you trade this way, you trade, you have a winner and you have a couple of losers. You might have a big winner and a whole string of losers, or winner, 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 and a big loss. You're treading water because you're taking 3 steps forward, 2 steps back, 2 steps forward, 3 steps back. You're always going back and forth like you're dancing. Okay? What we are talking about with a 95% success rate is the equivalent of taking 19 steps forward and a small step back, maybe a medium small step back. That's fine. You never worry about the loss. You always try to move forward. Okay, so here's the 11-hour option spread strategy workshop. It's an on-demand workshop available to you right now. It's going to teach you how to make full-time weekly profits, just like I've shown you, by being in the market 1/3 of the time. This is a trade that you are consistently in high probability income trades just 2 days a week. You can do these trades as a set it and forget it strategy that can manage itself. Okay, so you think about it, you put them on, you evaluate your trades at Thursday at noon, you select your trades, you get filled, you put your stop losses in, and then you leave it until Friday. If you hit your stop loss levels, you get knocked out. If not, then you hold them until expiration. This strategy is not just fluff. It actually includes a detailed step-by-step method for optimum spread strike prices. Okay? I will teach you the theory and execution of this method because you need to know what to do and why it works. Okay? And just as important, I'm going to teach you the risk control method that fosters long-term profitability. That means if we're trying to make $100, we're only willing to risk $200 or $300 of loss. But remember, that goes together with the consistency of the trade. 95% of the time, 19 steps forward, one step back. And understand, you don't have to wait for some crazy setup or from some signal from a scanner, because this trade is easy to understand, easy to set up, and it can be run profitably 52 weeks a year. It's great if you make a 33, 40, 50% return on a trade, but if you only get one or two or three of those a year, what are you doing the rest of the year? Every single week, we run the 11-hour options trade. And by doing so, my traders collect what they lovingly call a weekly paycheck. They can trade like crazy other stuff and do all sorts of combinations, but they always come back to their 11-hour options trade every week because that's what they use to pay the bills. Okay? All right, so the website that you can go to is www.basecamptrading.com/Dave. That is me. And how much is it? Well, think about it. How much would you be willing to spend? How much would it be worth to you to be able to do a set of trades that you could consistently and with high confidence put on in the markets a third of the week and take home that weekly paycheck? Would that be worth $300 to you, $500 to you, $900 to you, 1,000? Well, the thing about it is, we at Basecamp Trading want to give you the chance to succeed. We want you to get to know us and have a tool that you can approach the market and consistently make successful trades. That will give you the foundation that you can use to explore more trading and develop other trades, while all the time being able and ready to do your 11-hour option spread strategy. We're going to basically give it to you for $49. Okay? That's not any fluff. It's worth hundreds of dollars. But what we've found is if that you can see how consistent our trading is, how elegant our trading is, and how successful our trading is, you'll get to know us more. So this is our opportunity to get to know each other. It's my opportunity to share with you my philosophy on trading is basically consistency, high probability, high confidence trades that you can repeat over and over again. It doesn't require brain surgery, but it does give you an opportunity to learn a fundamental trading technique that can generate profits again and again. Go to www.basecamptrading.com/Dave and help me help you get set up for success with the 11-hour option strategy. Thank you.